but we're going to record this one as well. I'm going to go down and grab my, my pen here. So this is chapter 6, learning objective 3. It talks first about the presentation of inventory, which is a balance sheet item. And we're going to be talking about the analysis. So there's actually two things that we, financial analysis ratios that we use to look at inventory. So we're going to be looking at those as well. Okay, so so as you know, inventory is a balance sheet item. It's a current asset. And so you'll see it on the balance sheet under current assets. It usually is right below the receivables, as it says here. After we sell the inventory, right, it's expensed as cost of goods sold on the income statement, and that gets subtracted from net sales, okay? So when we actually are preparing our financial statements in accounting, we have to disclose as much information as possible in terms of calculation of asset, cost of goods sold, things like that. So we actually tell owners the type of system that we're using. We tell them the basis of how we actually created the values. We're going to be learning about something called the lower of cost or markets basis of valuing inventory today. It's actually quite simple. And of course, we have to disclose to them, to the owners, what method we used in calculating cost of goods sold and the inventory. So that was the FIFO, LIFO average cost. Okay, as you see here, this is a, these are the notes for financial statements from Walmart. And you see Walmart uses the LIFO method, last in, first out, for its US stores, okay? Walmart is a global company. They have stores in many different countries. They use a different method for their international stores. They use FIFO, okay? But for the US stores, they use LIFO, the last one in, as the first one they cost out. And so that's basically a disclosure that all companies, all public companies must make. So one of the interesting things about inventory is it's an asset account, and we cannot overstate the value of our assets on the balance sheet, okay? There's several principles we learned back in chapter 2 and for GAAP. One of them is historical cost. So we usually mark our assets to the price that we paid for them, or the cost of it. But we have to also never overstate the price of an asset or the value of an asset. And so in order to do that, we sometimes have to compare what we paid for it, which is the cost, versus the cost or to replace it if we bought it again today. And because we paid a certain price for the inventory, and it might have a very different value today, we use the lower of the cost or market to value our inventory on the balance sheet, okay? And we use, again, the lower of the two numbers, or you're going to get an idea of what that is in the next sample here. And again, it's important that we keep our assets valued properly. We can never, ever overstate the value of our assets, okay? And so we have to be, in essence, as it says at the bottom of the screen, we have to be conservative when we do the numbers. We have to respect the historical cost of it, that's true, but what happens when that historical cost of the inventory doesn't reflect the market value, or what we could buy it for today. So we tend to take the lower of the two to value our inventory. So here is an example of that. This illustration is in the book, and if you don't mind, I'm going to go ahead and put on my Kentucky Colonel hat and welcome you to Kentucky TV. We have lots of things here at Kentucky TV. Here's our inventory. We got some flat screen TVs. We got some satellite radios. We got some Blu-ray players. And we got some CDs. Okay, so this is our inventory. This is how much of the inventory we have in stock. So we have 100 flat screen TVs in stock. The next two columns show what we actually paid for it. So we bought these TVs for $600 each. However, if we were to go out today and buy them again, that's the market value. And we would take the lower of these two numbers to value our inventory. And so we have 100 flat screen TVs. We would take the lower of cost or market. That's the lower of cost or market system, which is $550. And so those 100 TVs would be listed at a value of $55,000 on our balance sheet for the value of inventory. For the satellite radio, again, the cost is lower than the market, so we would use the $90 cost to value those 500 radios that we have in stock, and that's where that number comes in, and so forth and so on. The number of units, and we would pick the lower of the cost or market to create our value. So this company would say the value of their inventory is $155,800 based on the lower of cost or market system of valuing inventory. Okay. This again guarantees that they're not overstating the cost of, the value of the inventory for the asset. All right, so do it exercise number 3 is on the lower of cost or market basis. Again, it's relatively straightforward. A company has inventory. In this case, Ch6 company, they sell home heating stoves, right? They have gas stoves, wood stoves, and pellet stoves. The cost to the company when they bought that inventory is listed in the first column. The market value of the same inventory is listed in the second column. We have to determine the value of the inventory with lower cost of market. So you're basically just picking the lower numbers for each of the types of stoves and adding them together. And so the actual value of the inventory on the balance sheet using the lower cost of market would be $430,000. And that's all there is to this. I mean, it's really very, very straightforward. There's nothing, no surprises here, okay? All right, so on to some financial analysis regarding inventory, okay? Pay no attention of the barking dog in the background, okay? So it's important to understand that, you know, inventory is the reason retail stores exist, okay? The reason they exist is to sell their merchandise. And so it's critical to understand that if you walk into a store and they don't have what you need, right, you're going to be pretty upset at that store. And of course, that's going to lead to lost revenue. If you have lost revenue, you also have lost profit, because remember, revenue has all of the expenses in it plus money left over for profit. So if you're not selling any inventory because you don't have any inventory, you're losing revenue, you're losing profit. Sadly, some stores buy too much inventory, okay? So high inventory levels are very problematic because if you have too much inventory and you can't sell it, you're kind of stuck with it. How are you stuck with it? Well, you're going to store it. So there's storage costs. You probably got to pay for it. And so there might be costs of interest, right? You're tying up this, all your cash in this level of inventory, right? And you need the cash to buy new stuff so you can sell it. So inventory management, if you're really, really good at inventory management and you understand these concepts, you have a pretty, there's some pretty good paying jobs out there for folks that know how to do this well, okay? And so the analysis will come down because inventory management is extremely important. There are two primary ratios we're going to be looking at. You have to do the first one first in order to get the second one, okay? So the first one is called inventory turnover. Now, turnover is how many times a company is selling its items and needs to replace it. That's a turnover. So, so the inventory turnover ratio is very important because it tells you how many times each year a company is selling out of their of goods from their store, which is what you want, right? If you're a company, you want to sell your stuff. So in essence, a high inventory turnover ratio should mean good things to your company, should mean you're more profitable. So to get this ratio, we need three numbers, in fact. The first number is the cost of goods sold, which of course comes from the income statement. The second number is the average inventory. So that's the beginning inventory plus the ending inventory divided by 2 will give you an average inventory. Once you do this math here, you'll get a inventory turnover ratio that tells you how many times a year a store is basically selling out and restocking itself. Once you get the inventory turnover ratio, you can put that number below 365, number of days in a year, to find out how many days you're keeping your inventory before it's sold out. Okay, so these are the two financial analysis pieces you need to know, and here's an example of those. Okay, so here is the data for Walmart. You know, why not? Okay, in 2014, right, they had ending inventory of 44,858. If the ending inventory for 2013 is going to be the beginning inventory for 2014. So this is the beginning inventory. This is the ending inventory. You need to take an average of these two numbers to get the average inventory. The cost of goods sold is just definitely given to you. So for Walmart, we're going to look at 2014 numbers here. This is the cost of goods sold. This is the average inventory. And so you see for Walmart, in 2018, they had an inventory turnover ratio of 8.1 times a year. Now, if you want to think about what 8.1 times per year is, and Walmart's a huge store. It's got over 125,000 products, different products in it. It's the same as Walmart selling everything in the store and restocking everything in the store 8 times a year. Okay, 8 times, that's really what that means. Okay, if you want to break it down. It's just an enormous amount of inventory that they go through. Okay, that's a little slower than their 2013 number, but still 8 times a year is a heck of a pace. Okay, you compare that with Target for the exact same year, 2014, and their inventory turnover rate was 6.1 times per year. So Target basically, if you want to analyze this, Target basically started with a full store. It got emptied and restocked 6 times a year. That's basically how you would look at inventory turnover. For the industry average is 8.4 times. So the industry has a very high turnover ratio. So that's the inventory turnover ratio. Now that you have that ratio, stick that number under 365 to get the number of days. And so for 2014, and we're back at Walmart, if you had 8.1 times per year for inventory turnover, and you divided it by 365 days, that means basically Walmart sells out their store in 45 days and restocks. So it's an amazing turnover. It's really, really fascinating. Obviously, it's a little bit slower than 2013 because in 2013, they were selling out the store and restocking every 44 days. So again, just an amazing turnover. Because Target only has a 6.1 time inventory turnover ratio, when you divide that below 365, they're basically selling out their stores every 60 days, okay? And so basically it sells out and restocks every 2 months. So that's a slower rate in both, okay? But that's basically what the inventory turnover ratio is. And once you get that and you put that underneath 365, it converts to the number of days that the inventory basically is disappearing off the shelves and needs to be restocked. Okay. We're going to go right to the do it exercise for inventory turnover here. This is the last thing that we're doing in the chapter, and as you see, we've only been together about a half an hour, so it's really not a lot left for chapter 6. So here we have 2017 is the year. Westmoreland Company is the company, and they switched to something called a just-in-time inventory system. You'll learn about that in more detail in managerial. It shows information from 2016 in the left column, 2017 in the right column, okay? And it asks us to determine the inventory turnover for both years, okay, 2016 and 2017. So remember, inventory turnover, right, is the cost of goods sold divided by the average inventory, those two together, okay? So we would need to average this out and divide it by the cost of goods sold. Same thing in 2017. We would need the average inventory, which are those two numbers averaged, and that's your denominator, the cost of goods sold is your numerator. So once you actually do that math, you'll see that in 2016, the inventory turnover rate was 4. Okay, inventory turnover only was 4. When you look at 2017, the inventory turnover rate was 7. So 7 is a much higher number than 4. If you're a retailer, you would want to sell out the store 7 times each year rather than 4 times each year, because you're making a lot more sales and you're selling a lot more inventory, which is the purpose of your business to begin with. So that's much better. Well, now that you know the inventory turnover rate, how do you convert it to days? Well, you simply just divide it by, you put the ratio underneath 365. So they went from turning over the store every 91 days in 2016 to selling out the store every 52 days. Obviously, much, much better. And so